Hello, good evening, everyone. Just a quick sound check. Can everyone let me know if you guys can hear me? Yeah. Okay. Okay. Just let me know if everybody can hear me loud and clear. Okay. I see most people say can hear. Can hear, yeah? Okay. Okay. Great. Okay. So seems like most people can hear. So yeah, I'll stop the poll and just a quick introduction about myself before I start. My name is William and I am actually from Phillip Capital Kuching branch, and I'm a dealing and also a marketing executive here at Phillip Capital. Okay, so before we move on to our webinars tonight, okay, our main topic, which is on the US indexes, just let me do a quick introduction about our company, Phillip Capital. Okay, so just a quick disclaimer, whatever that I share tonight is only for knowledge sharing purpose and is not a buy and sell call, okay? If you need personal advice, you can try to talk to me personally. I will put my contact details later on at the end of the event, okay? So you can jot down the numbers, our branch number, and you can talk to us personally, okay? So back to our company, Phillip Capital. Okay, so Phillip Capital, our company, we actually incorporate in October 1995. So we have been actually in the business for a very, very long time. Okay, so Phillip Capital Sdn Bhd is a wholly owned subsidiaries of Phillip Capital Holdings, our mother company based in HQ. And previously, we are called Phillip Futures Sdn Bhd. Okay, the reason for our change name is because at this moment now, we actually offer stockbroking services. Therefore, we change our company names from Phillip Futures to Phillip Capital. Okay, so our company, we are a trading participants of Bursa Malaysia Derivative and also a participating organization of Bursa Malaysia Securities Berhad. So with that, we have this CMSRL license, which makes us a legal broker house here in Malaysia. Okay, so our company, Phillip Capital, we actually have offices at 11 different states. Okay, we have offices in Penang, Alor Setar, Kota Damansara, Melaka, JB, Kluang, Kuantan, Sibu, Kuching, and KK. So if you are somewhere near all these areas, you can try to drop by our branches for a visit. Okay, we welcome you. So if you are our clients here, I want to take this opportunity to say a very big thank you to you. Okay, without you, we won't be able to achieve this. So last year in 2021, we actually won 3 main awards from Bursa Malaysia. The first one, we are the best overall derivative trading participants. We are also the best institutional derivative trading participant and also the best retail derivative trading participant. Okay, so our mother company, Phillip Capital, our mother company is actually based in Singapore. We actually have offices all over the world, at over 14 different countries. So with that, we don't only offer products in Malaysia. Okay, we also offer products from US, from Europe, from Japan, from Hong Kong, from Singapore, etc., etc. Okay, so what do we offer? So first, we used to offer only futures trading. Okay, so futures basically can break into indexes, which is something we are going to cover tonight. US indexes is part of this indexes futures. Okay, the second one is agriculture, metal, energy, and interest rate. So right now, we don't only offer futures already. We also offer stockbroking services. Okay, at Phillip Capital, we allow our clients to trade shares from Malaysia, from US, from Hong Kong, from Singapore, as well as Australia. So no matter what you want, what shares you want to buy over the country, over the world, you should be able to buy it with us. Okay, all the popular ones. Okay, lastly, we also offer contract for difference. So a lot of people, they are actually very new to contract for difference, but for your information, basically trading contract for difference with us is like trading shares. The only thing that is different is that we give very, very attractive leverage for our clients to trade the shares. Okay, if you want to know more about this, you can contact us personally. So why trade with us? Okay, first, we are an award-winning broker. Like I mentioned just now, we basically got award from Bursa Malaysia every year. Second, we offer 24-hour support. So if you trade the night market during the midnight, the US market, you have problems, you can dial into our dealing lines, which is 24 hours. Okay, if you need personal advice, how to trade, how to select products that is suitable for you, you can contact us for a one-to-one coaching session as well. Okay, and also our company, we actually have this daily commentary and the latest market news exclusively for our country, for our clients. Okay, so we help you to find products. Like I said, like I shared earlier, we actually offer products from all over the world. So definitely there is something suitable for you. And if you want to open account, we have online account opening. Okay, we have online account opening. So what do we offer other than that? We offer one-to-one coaching session. So if you are completely new to the financial market, be it the stocks market, be it the derivative market, if you want a one-to-one coaching session, let me know. We can schedule a time for you just to let you know everything you need to know about to kickstart your trading. Okay. Other than that, we have free seminars and webinars every month. Okay, something like tonight is always free. Okay, and account opening is free of charge. Okay, you just need to fund in a minimum of 1,000 to activate your account, and we have online account opening right now. If you want to open a futures trading account, you can scan this QR code, then you can open it at the comfort of your own home. Okay, now like I said, we actually have webinars every month that you can just scan this QR code and it will link you to our website that you can basically just join our events from our website. Okay, alternative, just go to our website www.phillip.com.my. You can try to register the events there as well. Okay, just a quick one to show you our trading platform. So if you are trading the futures market, we offer Phillip Nova for our clients to trade. So Phillip Nova, actually, we have over 90 different indicators. So definitely there is something for you. Our clients can directly buy or sell from the chart, okay? And we offer different market depths, like you can see. We have 5 levels of market depths for our clients, and you can trade both local and foreign products under one single platform, okay? So it's a very easy to use and user-friendly. We also have mobile trading, okay? For stocks, we actually have points for global market and Phillip trade for the local Bursa Malaysian market. Okay, so it's also a very user-friendly platform here. Okay, and it allows you to trade all the markets as you can see here. Okay, Malaysia, US, Singapore, Hong Kong, and Australia. Okay, so basically that is all for the trading platform. And let's move into our main topic tonight. Okay, which is learn to trade US indexes using futures or the exchange traded funds. In short, is the ETF. Okay, so just before I move on, just to say sorry because my throat is a bit dry, so probably will get interrupted just on and off okay. So just a quick run through about our outline tonight. So first, if you are new to the US indexes, basically US indexes, we have 4 main indexes, which is the S&P, Dow Jones, Nasdaq, and also Russel. I'm going to tell you what are the differences between these 4 indexes. Second, I'm going to share what are the fundamentals that move the US indexes, especially in the current market cycle. What kind of fundamental we need to look at in order for us to know what is next for US indexes. Okay, and the third one, everybody is talking about interest rate. Okay, so we will go deep into interest rate and how this interest rate is going to turn out next. Okay, and the last one, what kind of instrument you can use to trade the US indexes. Okay, so let's start from the differences between S&P, Dow Jones, Nasdaq, and Russel. Okay, as you can see, this is a summarized table here. Okay, this is a summarized table. So Nasdaq, usually we refer to a technology index. So inside Nasdaq, we have 100 big cap technologies company. Okay, there is 100 big cap technologies companies under Nasdaq. So they are all technology stocks. Okay, so if you love technology, then this is the index for you. Okay, the second one, we call it the Dow Jones. So Dow Jones is like a very traditional index. So what is traditional? The companies inside Dow Jones index are mainly on the industrial and also financial sectors. Okay, so what is industrial? like the CAT, the CAT, you know, all those Caterpillar. Caterpillar is like all those industrial, those machinery and stuff. Okay, the financial is like the what financial do we have? The very big banks like the Bank of America, Goldman Sachs, all these kind of companies. So there are only 30 companies inside the Dow Jones Index, and this is a very, we call it the traditional index. If you love banking stocks, then probably this is the index for you. Now, the third one is called the S&P 500. Okay, so this S&P 500 is a very, very balanced index. So what does it mean by balance? There are 500 companies, and it makes up of companies from technology and the industrial and financial sectors. So it's like a mixture inside. It's like a mixture. So usually, if you look at recently, right? If you look at recently, technology stocks, it drops more than the rest. Okay, it drops more than the banking stocks, more than the oil and gas stocks. You know, technology stocks is the one that dropped the most. So if you want to short, okay, you want to short, you know, technology is the most overvalued one, then you go and short Nasdaq. You know, but if you think that you want to long, then you know Dow Jones is a stronger index to long, because if you look at Dow Jones itself, right, year to date, let's say from the 1st of January until today, actually the drop is only like 10%, but Nasdaq is almost like 30%. Okay, so understanding what index and what is inside the index itself actually help you to choose what kind of index you want to trade. That will give you a higher success rate. Okay, so this is something very, very important. Okay, and the last one we call the Russell 2000. So Russell 2000 is the small cap index. Inside are all the small companies that is probably a lot of them we actually never heard of now, because they are the small cap index, and there are 2,000 companies inside. Okay, so these are the main differences. Okay, technology, traditional, a mixture between Nasdaq and Dow Jones, and also finally the small cap. So yeah, understanding them helps you lah. So just a quick one. What is inside the top 10 Nasdaq component stocks? So these are the top 10. Okay, you can just have a look. And if you want the full link, like all 100 stocks inside Nasdaq, you can just refer to this link. It shows you all the 10 stocks, all the 100 stocks inside Nasdaq. But the biggest one is Apple, followed by Microsoft, Amazon, Alphabet is the Google, Nvidia, Tesla, Pepsi, Costco, and Meta. Okay, these are the top 10 stocks under Nasdaq. Okay, so if you trading the Nasdaq, you look at the chart of all these companies. If they are all bullish, probably Nasdaq is going to go bullish as well. Okay, so understanding the stocks do helps a bit on trading the index. The second one is Dow Jones. So what is inside Dow Jones? As you can see here, the United Health Group is one of the biggest components inside Dow Jones, followed by Goldman Sachs, Home Depot, Amgen, McDonald's, Microsoft, Caterpillar, Honeywell, Visa, and Travelers. So these are the top 10 Dow Jones component stocks, and this is the weightage. And the last one is the S&P. As you can see, S&P, you don't get that 10% or more than 10% or on single counter. They are more balanced. As you can see, from number 4 onwards, everything is like 1% already. You know, so it's like it won't be overly heavy too heavy on one single sector. It's a very balanced index, like I said. Okay, so basically these are all the differences between the 4 indexes. Okay, so now we understand what is each indexes, so we know what we want to trade already. Okay, so now we need to know what are the things that is going to affect the indexes movement. Okay, what are the things that we need to pay attention? So usually this kind of information over here, okay, will actually affect the indexes movement. Okay, the first is the GDP data, or the economic one. Okay, second is the inflation. I think this one is one of the things that the whole market is actually looking at right now. If you are familiar with US indexes, you will know that, and you should know that usually when the US announce the CPI, the so-called inflation, okay, moment they announce it, US indexes get super duper volatile, okay, during the announcement date or the announcement moment. Okay, and the third one, we call it the interest rate. Okay, interest rate is like the higher the interest rate at this moment is always bad for the indexes. I think everybody knows that. Okay, I'm going to go deep later on. Okay, but now I just give you a brief view what is going to affect. Okay, and the fourth one is we call the unemployment rate. So unemployment rate, it includes a few things. People will look at non-farm payroll. This is one of the indicator. So non-farm payroll it means that the employment that for people that get employed non-farm, FARM, meaning people that get employed, those white collar people, meaning people that work in the offices. Okay, they don't work in the farm, not the farmer, exclude the farmer, people that work in the offices. What are the employment, how strong is the employment market for these white collar group people? Okay, and also there is this unemployment rate itself, how many percent of US population is currently unemployed. I think all these data are quite sensitive. Another one is the jobless claim. Okay, jobless claim is like how many people is actually has no job at the moment and is claiming some farewell from US government, something like that. Those things are grouped under unemployment. Okay, and the fifth one is the government policy. Okay, the tax rate, the quantitative easing, and we are now in quantitative tightening stage. Okay, these are all government policy. And corporate earnings, usually during the corporate earnings quarter, US indexes get very volatile as well. Okay, and lastly is the bond yield. So people look at bond yield to judge how high the interest rate is going to go. Okay, now these are the big picture. Every single thing here that I mentioned is going to affect the US indexes. But what are the main factors? Okay, what are the main factors? So at this current economic cycle, right? At this current economic cycle, there are three things that I personally think really affect the US indexes. And these are the three things that we need to really pay attention to in order for us to know where is US indexes heading to in the next 3 to 6 months. Okay, so I'm going to give you a bit of guidance on where to find the data and what are the things you need to look at for these three items. Okay, let's start from inflation rate. Okay, let's start from inflation rate. So for inflation, right, if you look at you actually can get this data from investing.com. Okay, you can get this data from investing.com. So usually inflation, we directly look at the consumer price index, we call the CPI, and usually we look at the year-to-year comparison. Why we look at year-to-year comparison? Okay, I just give you a bit of an explanation. Okay, the CPI year-to-year is the classic benchmark on US inflation. Why? It's because consumer price index is calculated by all the consumer goods in US. They add up and then they come up with an index. Okay, so increase in index means increase in inflation. A drop in the index means a drop in inflation. Okay, so how they compare this is like, imagine you see this October, right? In October, our CPI is 7.7%. Okay, so it means that they take the October consumer price index itself, compared in 2022, compared to this October 2021 index. So if you look at this one, right, you minus, then of course you get a very high, because previously in October 2021, the food prices, the energy prices is not so high yet. It's not so high yet. Okay, now this is a kind of like how you calculate it. You need to understand how this consumer price index is being calculated in order for you to predict where are we heading into in the future. Okay, how fast the inflation is going to come down, or how strong the inflation is going to stay there. Okay, like I mentioned now, if you look at this 298, right, this means that at this moment the consumer price index is sitting at 298. And if you look at from January 2021, the index itself, if you look at it, right, this is like the highest October, highest, it's highest. Now imagine, now in November, let's say in November, the index is not continue going up. It's not continue going up. Let's say this November is still 298. Is this year to year going to drop? Yes. Why? Because previously we are only talking like 2, 3, 276, 2774. So if you minus, you get, and the percentage is high. Now, when this thing continue to go up, right? You 298, this thing stays the same, 298. You minus 278, your percentage start to drop already. This continue to be 298. Inflation is not coming down, but last year December the index itself is 280. This one continue to come down. You see, you can see that it's coming down. Now imagine next year the food prices, the energy prices continue to stay the same at what we are seeing right now. Let's say continue throughout the year, and until let's say here next year June, this is 298. So if you take 298 minus 295 divide with 298, what divide with 295, what are the percentage? Your percentage is going to be like really low, you know. So you will see inflation from 7.7 probably down to 2%, probably just in next year June already. So don't be surprised if you suddenly see these CPI numbers. If you are familiar with CPI already, I'm telling you that next year, probably in June, CPI will collapse down to like 2%. Inflation going back to 2%. But does it mean that inflation is low? No. Why? Because you are still, our consumer price index is still at 298, you know. The food prices is still this high, the energy prices is still this high. But just because this year, 2022, is really high, the index itself. So even if the next year we see this thing maintain, right, the CPI is going to collapse as well. Imagine if the index here become 280, you will see a negative growth. Probably we are not talking about a 2% inflation. We are talking about a negative inflation, negative 2%, negative 3%. So how will the market react? Okay, if you understand the concept behind CPI, this is how CPI being calculated. Okay, so if you understand it, next year, April, May, June, July onwards, the CPI is going to collapse to 2% or lower. Okay, to 2% or lower. This is if you understand how you calculate it. Okay, so don't have to guess whether CPI is going to continue to go up or come down. It's going to come down. Okay, because this is super high already, you know. It's not easy to go higher than this. The only way is come down or maintain. Even if it is maintaining, the CPI has to come down. Okay, the growth rate, we are talking about the growth rate. Okay, so inflation has already reached a peak, and the year-to-year percent growth would started to drop dramatically in 2023. Okay, it's going to come down very steeply. Okay, now since we already know that inflation rate is going to come down, okay, so inflation is going to stay high, but the rate is going, the growth momentum, the momentum is going to come down dramatically. Okay, so this one we got our answer already. Now the second thing we need to look at now is employment rate, because the Federal Reserve currently is actually looking at these two items to decide on the third one. Okay, they are looking at inflation, they are looking at employment in order for them to decide whether they want to continue to maintain high interest rate era or they want to reduce the interest rate. Okay, they are looking at these two items. So we need to pay very close attention to these two items in order for us to guess the third items. Okay, so these two are the variables and these are the result. Okay, so now talking about employment. Okay, talking about employment. So if you look at this chart, right, this is United States unemployment rate. If you look at this chart, right, I draw a line here. Okay, this is like the best line, the lowest unemployment rate in year 2000. Okay, so if you see, I draw a line here, right, actually our unemployment rate right now is 7.3%, which is below that 4%. You know, in the past, before 2018, you know, unemployment has been always above 4%, but now we are talking about like 3.7%. I think the employment market in US is very strong right now. It's very strong. So you see, unemployment rate in US for October is 3.7%, indicating a very strong employment market in US. US market employment strong. Therefore, the Fed is likely to continue its tightening policy. Okay, US government is going to continue to maintain that very high interest rate era until they think the employment market is not able to take it anymore. Okay, they are going to keep it high in order to kill the inflation, but at the same time, as long as they think employment is strong, they're going to just keep that high interest era. They're going to stay there, hold there until inflation coming down. So what does it mean by inflation coming down? You need to see the consumer price index start to drop, which means a negative growth is something that we will probably see. Okay, a negative growth is something we will probably see in order to bring the inflation down. Okay, but at the same time, keep a very close attention to employment. Okay, because this thing, as long as this thing starts to go up, probably is going to mean two things. If unemployment rate start to go up, first, US is probably going to start to reduce the interest rate. Okay, to start to rebuild the economy first. Second, it probably means that US economy is going to be super duper terrible. Okay, US indexes probably is going to crash. Okay, if unemployment starts to go up to 4%, so need to pay very close attention. So if you are buying stocks, you are buying indexes, once you see the unemployment starts to go high, more than 4%, probably you need to be a bit more conservative, because this is not a this is exactly what the Fed wants to see now. They want to see high unemployment now. Okay, the only thing that will stop them to increase the interest rate or stop them from maintaining that high interest rate is unemployment rate going up. Okay, as long as they see this, we are still in the tightening process. Okay, another thing that we can look at is the jobs opening in the United States. Okay, you can just go to investing.com, you type this thing up. Okay, this is for you to see how many jobs is open in the US. Okay, so but this data is usually 2 months behind. So now tomorrow we are December already, but tonight they are only releasing the data for October. So it's always 2 months behind. Okay, so if you see the jobs opening is shrinking, right, and unemployment is going up, this is not a good sign. Okay, this is not a good sign. So you need to see all this data together. You don't see them individually, but you look at them together. Okay, you look at them together. Okay, so the third one. So we understand that, now I just summarize again. So we understand that inflation is going to stay high, but the inflation rate, the growth rate is going to drop. Okay, inflation is definitely continue to stay high. Unemployment is still strong, which means the interest rate is going to continue to go up, or is going to stay at very high level for quite some time until the employment market cannot take it. Okay, so when will Fed reduce its interest rate? This is something that we want to answer. For us to answer this question, we need to look at the 2 items that I mentioned just now. Okay, so the conclusion here, my own conclusion, is that Fed will remain high interest era to fight the inflation until the employment market is not able to take it. Okay, so until the employment market is not able to take it. So just pay close attention to these 2, because these 2 things is going to tell you what is next for US indexes. Okay, now the third one here is, should investor anticipate a smaller interest rate hike in December? Okay, should or should not? Okay, because everybody is saying that, oh, probably 5% is the peak. Okay, probably 5% is the peak. Now, how do we know? Those 5% is the peak is what people tell you. Okay, it's what people tell you, what the news tell you. But how are you going to counter check this particular information? Okay, you can see from this thing called the CME Fed Watch tool. Okay, this thing is actually from CME website. You can just copy this link. It's from CME group. Okay, this is a tools that CME created. It's like a poll for you to know whether what are the interest rate. Okay, what is the market expectation? This is usually the market expectation. Okay, so the next FOMC, right? So the next FOMC is actually in 14th of December. Okay, it's on 14th of December. As you can see, the target rate, this is the target rate, 4.25 to 4.5. So 67% of the people, the market expect that 67%, okay, that the upcoming hike is going to be within this range. Okay, so 67 probability that interest rate hike will be 0.25 to 0.5% in December, okay, which is 15 days later. So I also agree that 0.5 is probably something we're going to see this round. Okay, so how will the market react if the Fed increase 0.5 instead of 0.75? Because we have seen 0.75 for like 4-5 times already. Okay, for 4-5 times already. So suddenly Fed tell you 0.5. So how will the market react? Okay, this one I leave it to you. Okay, I leave it to you. But I'm telling you, market is going to expect 0.5. Okay, because the market expectation says so. Okay, now we look at February. Okay, now this is February. We look at the next one. So what is the February is the FOMC after December, 2 months later. Okay, so what is the market expectation? 53% saying that it's going to be within this range, 4.75 to 5, which means another 0.5. Okay, which means another 0.5. So 52% probability that interest rate will reach a peak of 5% by February. So probably by February we see 5% already. Okay, now what about next? We look at December now. We look at December. So we want, why do we look at December 2023? Because we want to know after we reach that 5%, when is it going to reverse downwards? When is it going to reverse downwards? You see, this one is December. As you can see, how many percent here? 29 plus 27. 50% of the chances that in December next year, US interest rate is going to be within 4.5 to 5. So what does it tell you? 50% market expect 50% of the chances interest rate is going to stay at 4.5 to 5. This means that we are going probably to experience that 5% high interest era probably until the end of December next year. Okay, interest rate is not going to come down until after December next year. This is what the market thinks, okay? Not what I think, but what the market thinks. So with this high 5%, can US market really, can the economy take it? Especially those corporates with very high borrowings. Can they accept 12 months of 5% interest? If we are talking 5% of the Fed fund rate, then probably outside the real corporate world, you are probably going to add another 3 or 4% up. The corporates are paying like 7 to 9% of bank borrowing percent per year. Are you able to take it if today your house loan interest is at 7 to 9%? Can you accept that? Are you able, can your salary afford a 7 to 9% interest rate every year on your house loan, on your property loan, on your car loan? You know, can you take this kind of interest rate for so long? Okay, this is a good question mark here whether US economy can take it or not, you know. Okay, so but at least now we got the answer. Not until next year December we are going to see that very high interest rate era. So if you have cash you can put in the bank, at least you get another 12 months for you to enjoy that high interest. Okay, for you to enjoy that high interest. Now, after we understand the interest rate, okay, sorry, just now here. So after we identify when the interest rate is going to drop, now, how we have a rough idea, how long does this peak interest rate last historically? Because just now, from this FedWatch tool, it tells you that the high interest probably is going to last 12 months, at least until December next year. Now, second question, what about in the past, in the history? How long is it going to last? How long is it going to last? Okay, now, if you look at this one, this is 1998, okay, 1998. Interest rate stays at 6.5% for 6 months, stays here for 6 months before the Fed decides to reverse it, before it drops. In 2008, the interest rate stays at 5.25% for 14 months before the Fed decides to reverse it. Okay, 2008, 14 months at 5.25. And what happened in 2008? What kind of recession we talk about in 2008? what kind of recession we talk about in 1998 when interest rate is so high for this long, you know? And in 2020, is there a recession? Yes, yes, but a very short one. The recession is like 1 month, 2 months. I think the recession is out of the blue. You know, interest rate stands at 2.5% for 5 months only. You know, for 5 months only, and it's only 2.5. It's not so high. Now we are 4, and we are expected to go up to 5. And that 5, according to Fed Watch tool, the market expectation is going to last at least for another 12 months. Okay, so what kind of recession that we are going to talk about? Okay, so if you look at this, in the past, in the history, interest rate is likely to stay at the peak for at around 6 to 14 months before the Fed will decide to reverse it. Okay, so what kind of damage will it do to the companies? Now, here comes to the third question. What kind of damage? So recession is a fact already. Okay, everybody knows now. No matter you ask a kid, probably a Form 5 student, probably a high school student, or a university student, they will tell you recession is definitely here next year. But the only question is how deep. You know, how deep is the recession going to be? Because we all know that recession is here already. I tell you there is a recession, it's nothing because you also know it already. But how deep probably is something that we can answer to know how deep is the correction going to be. You know, how deep is the US indexes correction going to be? Is how deep the recession is. Okay, now we look at some data here. In year 2000, year 2000 is like a dot-com bubble. Year 2000 is like a dot-com bubble. Okay, there is a minor recession. This recession is not so crazy. It's a minor recession. That time, the peak unemployment was at 5.5%. The peak unemployment is at 5.5%. And in 2008, this is the Great Recession, okay, due to the housing bubble in US. This one, the recession, I think is more serious. The unemployment rate reached 9.5%, okay? Okay, this one, yes. And in 2020, the recession is very short-lived due to COVID, and that time the unemployment rate reached 14.7%. And if you look at this line, right, this is zero. Okay, this is zero. So this chart here shows the inversion. Okay, the 10 years yield versus the 2 years yield. I'm not sure whether you guys are familiar with these 2 yield. If you read the news, right, actually early of the year, or usually when the markets try to blow the recession news, right, they always use the inversion. We call it the inverted yield curve. So if you look at this, right, this means that if it goes below the black line, if the candlestick go below the black line, it means that the 2 years yield is like an interest rate. Okay, yield is like an interest rate. So the 2 years rate is actually a lot higher than the 10 years one, which is why you see a negative yield, because 10 years minus 2 years you got negative, which is not supposed. So the concept here is that imagine today you put your money in the bank and the bank tell you that 2 years interest rate is higher than 10 years. Do you think it's normal? It's like I tell you, you put money in the bank for 2 months, it's higher for you to put money in the bank for 10 months. Is it normal? 2 months interest rate is higher than 10 months. This is not normal. Okay, this is not normal. If suddenly the bank tell you these are 2 months interest rate is higher than 10 months, you probably need to worry about our Malaysia economy. Okay, you need to worry about our Malaysia economy. And this is exactly what is happening in the US bond market. The 2 years bond, the return is way higher than the 10 years, which is why you see the inversion, the negative yield. We call it the negative yield curve. Okay, we call it the negative. This means that something is very wrong in the US financial market. Only you will see inversion. It means a recession is coming. Why? Year 2000, it goes into negative. Year 2008, it goes into negative. Year 2020, it goes into negative. Okay, slightly, very short one. But this round, you see how badly is the negativity. It reached 0.76% minus. This is really, really crazy. Okay, you see I put a question mark, means how do you expect the recession going to be? Because all this one, the inverted is not so serious, but this round here, probably people are not realizing it yet. But how deep is it going to be? How bad the economy is going to be next year? Usually, if you can do some research, usually this 10 years versus 2 years yield curve, the inversion will tell you some story in advance. Okay, so inverted yield curve in year 2000, 2009, 2020 all lead into a recession. Okay, the inversion all lead into a recession. And currently, we are experiencing the deepest inversion in history. This is like the deepest ever. If you go back to even 1998, you don't see this deep of inversion, not as deep as this one. Okay, so this deep, what does it mean to the upcoming recession? Is it going to be the worst ever recession that is going to happen in the US history? We don't know. But definitely the risk for it to happen is there, in my opinion. Okay, because why? Our inflation in US now is like 40 years high. Have you ever thought of a 40 years high inflation happening in year 2022? I don't think you ever imagine that. Have you ever imagined US interest rate can reach 5% 10 years after? If you look at this interest rate in US, the last time interest rate is at 5.25 is in 2008, 2007. You know, 10, 12 years later, 14 years later, you ever imagine we are coming back to here again? You never imagine. Now, we try to imagine again. This 10 years, 15 years, 20 years, something that we never see, we have seen it, the inflation rate, the interest rate, but the recession. Are we going to see the same thing that we have never imagined? In my opinion, I think the chances for it to happen is there. Okay, probably it will happen at the second half of 2023 or probably in 2024. We never know, because the inversion usually happens 12 months or to 15 months earlier. So when we see this, usually 12 to 15 months later, you will see a very, very serious recession. Okay, so historically, US indexes experience major correction only when this yield curve starts to go up. So if you look at the chart now, the yield curve still going downward. So the correction is not coming yet. Moment this thing starts to turn positive, starts to go way up, probably is the time that we see a major correction on the US indexes. Okay, so this is our third point here. Now, the last point here, will US indexes boom after interest rate hike reach a peak? So everybody thinks, we all know that, like all the fact that I told you just now, February next year, interest rate is going to reach 5%. So 5% is about here already. This is 5.25 in 2006. I think it's about there. It's about there. We reached a peak already. So people tell you interest rate peak already, it's time to buy because all the bad news already come out. Is it true? Ask yourself, is it true? Okay, is it possible for US indexes to move? In my opinion, okay, probably it won't collapse immediately, okay, because it's possible for US indexes to move in a minor uptrend, probably can still go up a little bit, move in consolidation, very wide range, high and low, very wide, very volatile, because the interest rate bad news already all coming out to the market, okay, everything out already. But if you look at this 2008, right, this is the same timeline. You see, in 2008, interest rate go up, US indexes up. Although this round is a bit different, interest rate up, our indexes down, US indexes down. But in 2008, when the big drop only happened when the Fed start to reduce the interest rate. You see this orange line, US start to drop the interest, the US market collapse. You see, so will this thing happen again? I don't know. I don't know whether this one will it happens again, same timing, same incident, repeat historically itself. I don't know, but just stay alert lah. If it happens in the past, it's possible for it to repeat. It's possible for it to repeat or not. I don't know. But historically, it happens when US starts to reduce the interest rate. Okay, and we never know when Probably, like I said, if you look at the Fed Watch tool, you just pay close attention, probably until the end of next year. Okay. So the big drop usually happens when Fed reduce the interest rate, as it is a sign of bad employment market and a recession. So the Fed needs to reduce the interest rate to save their economics. Okay. So yeah, basically these are all the big picture that you need to understand now if you are trading the US market. Because without understanding this, you won't be able to know what is next for US indexes. We want to know what is next is because we know which direction we want to focus. Okay, we want to focus. Now, just a short one. This is a technical outlook, means we look at the chart to decide. Okay, just a very quick one. So this is just for the very short term, This is just for the very short term. Okay, so if you look at the recent bearishness, I'm not sure whether any of you actually look at US indexes recently in a 1-2 months. But one of the way that I look at US indexes, the way that I catch the US indexes is I like to plot down all the big reaction, all the big incidents for me to know whether these incidents, if it is a bad incident and the indexes doesn't go lower, means it's probably the time for it to go up. Okay, so if you look at 13th of October, right, CPI is higher than expected, means it's bad for the market. Okay, but US indexes drop first, then cross into strength. Okay, cross into strength. And on the 27th, very bad earnings report by the FANG stocks, very bad earnings, but doesn't drop. You see, it doesn't drop. And on the 10th of November, CPI is lower than expected. So this is this. Sorry. So this is a good news. And you see, S&P actually rallied 5.5%. So this is the bad news. Indexes go up. This is the bad news. Indexes doesn't drop. This is the good news. Indexes rally 5.5%. Okay, and this is China lockdown. Okay, China protests for the lockdown on just 2 days ago. Indexes doesn't drop as well. You know, as you can see, if you look at all the incidents, actually they all point to a bullish short term, probably until December. Okay, a short term lah. Bad news doesn't drop. Bad news doesn't drop. Good news, direct rally, big rally. You know, these are like, okay, you know, bad news just doesn't make the indexes go lower, which means it needs to go a bit higher. Okay, so my own personal outlook for December, probably coupled with window dressing, is probably not so wise to short, even if the economy is not so good. Okay, but still, I believe it's not easy to break new low. Not easy to break new low in December. Okay, it's not easy to break new low in December. So the recent bearish incidents are not able to make S&P lower. So as long as S&P hold above 3750, as long as it hold above this level, it's likely for S&P to have another minor bull run. Okay, it's likely to have another minor one. Not a big bull, but just a minor one. Okay. So now, before we end, just a quick one. The last section here is the alternative instruments. Okay, so usually if you want to trade the US indexes, there are only two ways. The first way is through the futures. It's through the futures. But this one, if you are a trader, you are experienced with very high leverage product, then this is definitely the product for you, because the margin is not high. The margin is easy to swallow as well. Okay, for a lot of traders, Russel margin is about 600 plus USD. Micro Dow Jones is about 825 USD. Micro S&P margin is about 1,000 ish. Nasdaq is slightly higher, 1,007 USD. Okay, so this is the value per tick. If you are new to the futures market, right? If you are completely new, you want to know how these margins works, how to calculate the value per tick, how to calculate your profit and loss, you can contact us. Okay, you contact us for us to let you know more about it. Okay, we can do a one-to-one coaching session to let you know more about how these futures on US indexes work. Okay, because the trading hours is like 23 hours. So if you are a trader, this is for you. But if you are not high leverage trader, you can look into ETF on US indexes. So basically trading this is more or less the same like trading the futures. If you are completely new clients, you are completely new investors, you want to invest in US indexes, you can start from the non-leverage. Okay, this one means that you can screenshot this. This is the ticker for you to trade them. If you want to trade Nasdaq, You want to long, long means buy low, sell high. So you Nasdaq go up, you make profit. Okay, if you buy this, the short one, PSQ, means Nasdaq drop, you make money, you profit from the drop of Nasdaq. Okay, non-leverage. You can screenshot this lah. So if you want 2 times leverage means if Nasdaq go up by 5%, your profit by buying QLD is going to be 10%, 2 times leverage. Now, if you buy TQQQ, Nasdaq go up 5%, your 5% times 3, your profit will be 15% because there is 3 times leverage. Okay. Now, for the other way around, if you buy the short, right? You buy the short indexes that we call the inverse ETF. Inverse means if Nasdaq, if you buy the non-leverage, Nasdaq drop 5%, you profit 5%. You buy the 2 times leverage, the QID, Nasdaq drop 5%, you profit 10%. If you buy the 3 times leverage, the SQQQ, Nasdaq drop 5%, you profit 15%. Okay, so no matter which one you trade, basically it just depends on your risk appetite. So if you are a low risk appetite, you start from this row. Okay, choose the index that you like. Choose the index that I just mentioned. I explained just now the differences. Pick the one that is suitable for you. Then you can select from the non-leverage here to trade. Okay, if you are like a moderate risk appetite trader, you pick the one in the blue column. Okay, if you are a high risk trader, then you look at the 3 times average. Okay, and also just to let all of you know, you can actually trade all these ETF at Phillip Capital. Okay, we do allow our clients to do e-trading via the Points Global Mobile, Points Global Malaysia, the platform that I just shared during the very early stage. Okay, you are able to trade all these things, and a lot of people, they actually like to do dollar cost averaging on this QQQ or the SPY. Okay, this is the S&P 500 ETF with no leverage. So there is no, all these things, there is no margin call, by the way, no margin call. So benefit, no margin call. You want to long also can, you want to short also can, and you can trade without margin call. Okay, so if you want to learn more about all these ETF or which one is the right one for you, you can contact me now. You can let us know. Okay, so now we are actually having promotions. Okay, we are actually having promotion. You can trade all the products that I just mentioned at 0.08%. Or for US market, our minimum is USD8 during the promotional period. Even no promotional period is only around 10 to 11 USD. It's still very, very cheap. Okay, compared to all the banks, we are one of the cheapest broker in the market at the moment for foreign market. Okay, for foreign market. So if you want to learn more about our brokerage, how we charge, you can talk to us. Okay. Other than that, if you want to trade gold or silver, you can trade a USD3. This is also a promotion. Okay. Now we move on to Q&A. Before that, before we move on, just a quick one to let you know about our contact. Before we move on, so you can actually find our company Phillip Capital at our social media, Facebook, YouTube, Telegram, Instagram. We are all over the place. Okay, and this is our company's website, and this is our contact here. If you want to contact us, we are actually from Kuching branch. This is our branch number. This is me, William. These two, Abigail and Michelle, are my colleague. Okay, if you want to talk to us, you can contact us. Now, let's start our Q&A section. If you have any questions, you can put in the box. Okay, you put in the box, and I will try to answer all the questions. Okay, any questions that you want to know? There is a question from Alan Lee. Will you be sharing the deck after the call? Will you be sharing the deck? What is the deck? You want my slides, is it? If you want my slides, you can either email us, or I can give you my slides, no problem. Okay. Next question here is by Mr. Wong Hongji. Trading ETF at 0.08% of what amount? Okay, this is a good question. So depends what is the value that you buy. So our brokerage during promotional period now is that 0.08% or USD8, whichever is higher. So if you buy, let's say example, 1,000 USD market value. So you just tap 1,000 times 0.08%. Okay, so 1000 plus 0.08% is like how much? So 1000 times 0.08 is like 80 cents. Then we will directly charge you 8 USD. So the minimum will be 8 USD. It depends on the value. Okay, it depends on the value that you buy. Okay. Oh, okay, Alan, I can send you the slides. I can send you my slides here. Okay. Yeah, I can send you my slides. So any other questions before we finish the webinars tonight? Yeah, if you want to know more about how to trade the US indexes, actually if you want to trade US indexes at a bigger direction using all the fundamentals that I just shared just now, actually ETF is a very, very good way to go. And if you want to open a stocks trading account, at the moment, we are waiving the 10 ringgit CDS fee. So you just need to contact us to let us know that, oh, you are interested. We can guide you how to kickstart this ETF. Like, be it you want to start with the dollar cost averaging, what kind of price is suitable to start the dollar cost averaging? Yeah, I think we are able to help you with that. Okay. Next question here from Eunice. If I want to trade ETF S&P 500 in the next 18 months, should I long or short S&P? Okay, this is a very good question. In the next 18 months, first of all, first question you need to ask yourself, do you want to invest in S&P 500 or you want to just trade? Okay, if you want to just trade, try to avoid short in December. You can look into short S&P 500 probably in 2023. Because like I said, if you look at it recently, the chart, the technical outlook that I shared just now, recently all the bad news doesn't make US S&P indexes go lower already. So if it doesn't go lower with all the bad news, means it wants to probably go a bit higher. Okay, so avoid short in December and look into short probably next year. Okay, so this is my own opinion on S&P 500. So the second question here, next question is from Ken. So the platform have monthly fee or not? No, we don't charge any monthly fee to trade US foreign market. We don't charge any monthly fee. Okay, and ETF is like trade stocks, not a futures product. Yeah, your concept is correct. You trade ETF like the stocks. There is no margin call. You buy the market value and you just hold to it. Okay, the only difference between stocks and ETF is that ETF is a bit like unit trust, is that the companies, the management companies will have a management fee. They will charge a management fee to manage the ETF like the unit trust. I think it's not high, like 0.0 something percent only, not high. Yeah, they will directly deduct out from the share price. Yeah, once a year. So yeah. So Eunice have another question. If you want to invest in US ETF, so if you want to invest, then you wait for the big crash. You wait for the big crash. There are a few ways to do it. You either do the dollar cost averaging. Okay, when you think the price is suitable, you just fix your plan and do the non-leverage one. You just buy as you go. If you are a new player, okay, if you are a new investor, you can start off with the non-leverage. If you are experienced already, you want something faster, then you can try off with the 3 times leverage. Okay. Now, Ken, there's another question here from Ken. The platform futures also don't have monthly fee. Have any charting? Yes, our futures platform also no monthly fee on US market, and we do have live chart inside our platform. Yeah, for US futures product. Yeah, so if you want to try out, you can open an account. It's free of charge and everything is inside. You can try out first. Yeah, you can have a look. If you have a question, you can contact us. Okay. Abdul Rahman, he is asking if there is no margin call in S&P, if floating. If you are trading the ETF, there is no margin call in floating. No, ETF no. Futures got margin call. Futures got margin call. ETF no margin call. Okay. Next question here is by Mr. Allen. Is Phillip Capital a market maker? No, we are not a market maker. All the products that is offered by us is through the exchange. We are just an intermediaries. We are just a broker house. We give you a platform to buy and sell only. Be it the futures market, be it the ETF market, the stocks market, or anything, everything trade through the exchange. Everything trade through the exchange. We are not a market maker here in Malaysia. Okay. Just one last question from Mr. Ken. S&P 500 mini, the brokerage fee, how much? Ken, if you want to know more about brokerage, maybe you can contact us personally, or maybe tomorrow I can give you a call. Then we let you know more a bit details about the brokerage and stuff. Okay, yeah. If there is that all the questions that we get from the floor tonight? Yeah, if no other questions, I think we can call it a night. But if you need my slides, you can let us know. I can give you my slides. If you still don't understand how to look at US market, then you also can contact me. I can probably explain it one more time to you. What are the key market fundamentals to look at in order for you to judge what is next for US market? Okay, if you want to open futures account again, you can scan this QR code. Okay, yeah, those people that leave a comment, you need my slides, I can send you tomorrow. Okay, have a good night and thank you for joining us tonight, everyone. Bye bye.